Hi everyone! Welcome to our channel, where we strive to empower you with knowledge on various topics. Today, we have a special topic that many of you have requested: investing. In this video, we will dive into the different types of investments available and provide you with a beginner's guide on how to get started. So, let's get right into it. Before we jump into investing, let's understand the different types of investments available. Broadly speaking, there are four main categories: stocks, bonds, real estate, and alternative investments. Now let's delve deeper into one of the most popular types of investments: stocks. Stocks represent ownership in a company. By purchasing stocks, also known as equities, you become a shareholder and have a claim on the company's assets and earnings. Stocks offer potential growth and dividends but also come with risks and volatility. Capital appreciation refers to the increase in the value of a stock over time. If you buy a stock at a certain price and its value rises, you can sell it at a higher price and earn a profit. This profit comes from the difference between the buying and selling prices. Stocks can be classified into different types based on various factors. Here are a few common types of stocks you may come across. Common stocks. These are the most prevalent type of stocks. When you buy common stocks, you become a partial owner of the company and have voting rights in certain corporate decisions. Preferred stocks. Preferred stocks have characteristics of both stocks and bonds. They offer a fixed dividend payment to shareholders and have a higher claim on the company's assets in case of bankruptcy. Blue chip stocks. Blue chip stocks are shares of well-established, financially stable companies with a history of consistent performance. They are considered relatively safer investments. Growth stocks. Growth stocks belong to companies that are expected to grow at an above-average rate compared to the overall market. These stocks may not pay significant dividends but have the potential for substantial capital appreciation. Value stocks. Value stocks are shares of companies that are considered undervalued relative to their intrinsic worth. Investors look for value stocks that are trading at a lower price compared to their fundamentals. Dividend stocks. Dividend stocks are shares of companies that regularly distribute a portion of their earnings to shareholders in the form of dividends. These stocks are favored by investors seeking regular income. Small cap, mid cap, and large cap stocks. Stocks are often categorized based on the market capitalization of the company. Small cap stocks belong to relatively smaller companies, mid cap stocks to medium-sized companies, and large cap stocks to large, well-established companies. Now let's shift our focus to another important type of investment: bonds. Bonds are fixed income securities that represent a loan made by an investor to a borrower, which can be a government entity or a corporation. When you invest in bonds, you become a creditor of the issuer, and the issuer promises to pay you interest over a specified period, followed by returning the principal amount at maturity. Bonds are often considered less risky compared to stocks because they offer a fixed rate of return and are generally more predictable in terms of income generation. Here are some key points to understand about bonds. Types of bonds. There are various types of bonds available in the market, including government bonds, corporate bonds, municipal bonds, and treasury bonds. Let's briefly explore these different types. Government bonds. These bonds are issued by governments to finance public projects or meet their financial needs. They are generally considered low risk because governments have the ability to raise funds through taxation. Corporate bonds. Corporate bonds are issued by companies to raise capital for business operations, expansion, or other purposes. These bonds may offer higher yields than government bonds but also carry a higher level of risk depending on the financial health of the company. Municipal bonds. Municipal bonds are issued by local governments or municipalities to fund infrastructure projects such as schools, roads, or hospitals. These bonds may offer tax advantages, as the interest income is often exempt from federal taxes and sometimes from state and local taxes as well. Treasury bonds. Treasury bonds, also known as T-bonds, are issued by the government and are considered the safest form of bonds. They offer fixed interest payments and are backed by the full faith and credit of the government. Bonds have a coupon rate, which is the fixed interest rate paid to bondholders. This rate is typically expressed as a percentage of the bond's face value. The interest payments, known as coupons, are made periodically, such as semi-annually or annually. The yield of a bond represents the total return an investor can expect to receive over the life of the bond, taking into account the coupon payments and the bond's current price. Bond yields can fluctuate based on changes in interest rates and the creditworthiness of the issuer. Bonds have a maturity date, which is the date on which the issuer will repay the bond's face value to the investor. Bonds can have short-term maturities, less than 1 year, intermediate-term maturities, 1 to 10 years, or long-term maturities, 10 years or more. The par value, also known as the face value, represents the amount the issuer will repay to the investor at maturity. Bonds are typically issued with a par value of $1,000, but this can vary depending on the issuer. Credit rating agencies assess the creditworthiness of bond issuers and assign ratings that indicate the issuer's ability to fulfill its financial obligations. Common credit rating agencies include Standard & Poor's, Moody's, and Fitch. Ratings range from AAA, highest, to D, default. Real estate is another popular investment option that offers the potential for long-term appreciation and passive income. Investing in real estate involves purchasing properties with the intention of generating income or selling them for a profit. Let's explore some key aspects of real estate investing. The first one is rental properties. One common approach to real estate investing is owning rental properties. This involves purchasing residential or commercial properties and renting them out to tenants. Rental income from tenants can provide a steady stream of cash flow, which can be used to cover expenses and generate a profit. However, it's important to consider factors such as property location, rental demand, maintenance costs, and tenant management. Being a landlord comes with responsibilities, including property maintenance, addressing tenant issues, and ensuring legal compliance. The second one on our list are real estate investment trusts, REITs. For those who want to invest in real estate without directly owning properties, real estate investment trusts, REITs, are a popular option. REITs are companies that own and manage income-generating properties, such as office buildings, shopping malls, apartments, or hotels. Investing in REITs provides an opportunity to benefit from real estate returns without the hassles of property management. REITs distribute a significant portion of their income as dividends to shareholders, making them an attractive option for income-oriented investors. Another one on our list that has gained popularity in the recent years is real estate crowdfunding. Real estate crowdfunding has gained popularity in recent years. It involves pooling funds from multiple investors to collectively invest in real estate projects. Online platforms facilitate these investments, allowing individuals to invest in a diverse range of properties with lower capital requirements. Crowdfunding platforms provide opportunities to invest in various types of real estate projects, such as residential developments, commercial properties, or even real estate loans. Returns can come in the form of rental income, capital appreciation, or profit sharing from project sales. The last one on our list is flipping properties. Flipping properties is a strategy where investors buy properties, renovate or improve them, and then sell them for a profit. This approach requires knowledge of the local real estate market, property valuation, and renovation costs. Flipping properties can be lucrative, but it also carries risks. Market fluctuations, unexpected renovation expenses, and holding costs can impact profitability. It's essential to thoroughly research the market, carefully evaluate potential properties, and have a solid renovation plan to maximize returns. Real estate investing offers various strategies to suit different investor goals and risk appetites. Some common strategies include buy and hold. This strategy involves purchasing properties with the intention of holding them for an extended period, generating rental income, and benefiting from long-term appreciation. Value add. Investors seek properties with potential for improvement or renovation. By adding value through renovations, repositioning, or lease optimization, they aim to increase property value and generate higher returns. Development. This strategy involves investing in new construction or development projects. It requires expertise in market analysis, construction management, and understanding local regulations. REITs and funds. Investors can also participate in real estate through REITs, real estate mutual funds, or exchange-traded funds, ETFs. These options provide diversification and professional management. Apart from traditional investment options like stocks, bonds, and real estate. There is a wide range of alternative investments available to investors. Alternative investments typically refer to assets that are not part of the traditional investment classes. Let's explore some popular types of alternative investments. Hedge funds. Hedge funds are privately managed investment funds that pool capital from high-net-worth individuals and institutional investors. Hedge funds have greater flexibility in investment strategies compared to traditional mutual funds. They can use various techniques such as short selling, leverage, and derivatives to potentially generate higher returns. Hedge funds aim to provide positive returns regardless of market conditions. However, they also carry higher risk due to their complex strategies and may have higher fees and investment minimums compared to other investment options. Private equity. Private equity involves investing directly in private companies that are not publicly traded on stock exchanges. Private equity investors provide capital to companies in exchange for ownership stakes. The goal is to improve the company's performance and ultimately sell it for a profit. Private equity investments are typically long-term and illiquid, meaning it may take several years to realize the returns. Private equity investments require significant due diligence and expertise, as they involve analyzing the company's financials, management team, and growth potential. Venture capital. Venture capital, VC, investments focus on funding early-stage or startup companies with high growth potential. Venture capitalists provide capital and expertise to these companies in exchange for equity. They play a crucial role in supporting innovation and entrepreneurship. Venture capital investments can offer substantial returns if the startup becomes successful or goes public. However, they also carry high risk, as many startups fail to achieve significant growth or profitability. Investing in venture capital requires extensive research, industry knowledge, and a high tolerance for risk. Commodities. Commodities are physical goods such as gold, silver, oil, natural gas, agricultural products, and more. Investing in commodities can provide diversification and a hedge against inflation. Investors can participate in commodity markets through futures contracts, exchange-traded funds, ETFs, or commodity-focused mutual funds. Commodity prices are influenced by various factors like supply and demand dynamics, geopolitical events, and weather conditions. Investing in commodities requires understanding market trends, conducting thorough research, and managing risks associated with price volatility. Cryptocurrencies. Cryptocurrencies, such as Bitcoin, Ethereum, and others, have gained significant attention in recent years. Cryptocurrencies are digital assets that use cryptography for secure transactions and operate independently of central banks. They are decentralized and based on blockchain technology. Investing in cryptocurrencies can be highly speculative and volatile. The cryptocurrency market experiences significant price fluctuations, driven by factors like regulatory changes, market sentiment, and technological advancements. It's crucial to educate yourself about cryptocurrencies, understand the risks involved, and consider them as a part of a diversified investment portfolio. Art and collectibles. Artwork, rare coins, stamps, vintage cars, and other collectibles can also be alternative investment options. The value of these items can appreciate over time, making them potential investment assets. However, investing in art and collectibles requires expertise in a specific market, authentication, and careful selection of the items. Now that we have an overview of the different investment options, let's discuss how you can get started with investing. Before you start investing, it's crucial to define your financial goals. Are you investing for retirement, buying a house, or saving for your child's education? Having clear goals will help you determine the investment strategy and time horizon. Investing can be complex, but with the right knowledge, you can make informed decisions. Read books, attend seminars, and utilize reputable online resources to gain a solid understanding of investment concepts, strategies, and risks. Before diving into investments, it's essential to establish an emergency fund. This fund should cover 3 to 6 months' worth of living expenses. It acts as a safety net, protecting you from unforeseen financial emergencies. Every individual has a different risk tolerance, which is the level of comfort with potential investment losses. Understanding your risk tolerance will help you choose the appropriate investments. Conservative investors may prefer bonds and stable stocks, while aggressive investors may opt for high-growth stocks. One of the best ways to start investing is through retirement accounts like 401(k)s or individual retirement accounts, IRAs. These accounts offer tax advantages and help you save for retirement. Take advantage of any employer matching contributions if available. Contributing to a retirement account allows you to save for the future while potentially reducing your taxable income. Employers often offer matching contributions, which means they will match a portion of your contributions. This is essentially free money, so be sure to contribute at least enough to maximize this benefit. Use a retirement savings calculator to determine how much you need to save for a comfortable retirement. Consider factors like your desired retirement age, expected expenses, and investment returns. This will give you a target savings goal to work towards. To make saving for retirement easier, set up automatic contributions to your retirement account. This ensures that a portion of your income is regularly allocated towards your retirement savings without requiring constant manual effort. Remember, it's never too early to start saving for retirement. The power of compounding returns means that even small contributions made early on can grow significantly over time. So, take advantage of retirement accounts and start building a strong financial foundation for your future. Diversification is the key to managing risk in investing. Spread your investments across different asset classes, industries, and geographic regions. This helps reduce the impact of any single investment on your overall portfolio. To invest in stocks, bonds, or exchange-traded funds, ETFs, you'll need a brokerage account. Look for reputable online brokerage platforms that offer low fees, a user-friendly interface, and educational resources to support your investment journey. Developing an investment plan will keep you focused and disciplined. Determine how much you can invest regularly, set target allocations for different asset classes, and establish a timeline for reviewing and rebalancing your portfolio. Now comes the exciting part, making your first investments. Start small, especially if you're a beginner, and gradually increase your investment as you gain confidence and knowledge. Remember, investing is a long-term commitment, so be patient and stay focused on your goals. Once you've started investing, it's important to regularly monitor your portfolio's performance. Keep an eye on market trends, review your investments, and make adjustments if necessary. However, avoid making impulsive decisions based on short-term market fluctuations. And there you have it! A comprehensive guide to understanding different types of investments and getting started with investing. Remember, investing is a journey that requires continuous learning, adaptability, and patience. By diversifying your portfolio and staying disciplined, you can increase your chances of achieving your financial goals. If you found this video helpful, don't forget to give it a thumbs up and subscribe to our channel for more informative content. Also, feel free to leave any questions or comments down below. Until next time, thank you for watching and happy investing.